All right, so let's talk about option spreads. In the next few minutes, I want to show you what are option spreads, why should you trade them, when does it make sense to use option spreads, and I want to give you some very specific examples. So let's jump right on the screen here and let's talk about an example. So as you know, the way how I trade, I like to take my stock picks and option picks from the PowerX optimizer. Now, there were several picks today. For this specific examples, I want to use BE, Bloom Energy Corporation. So PowerX optimizer said that Bloom Energy Corporation is a buy at $9.58. Now, it hasn't been triggered today, but the idea here is because I want to show you this very specific example. So as you can see, I prepared a little bit for you, because I want to show you when does it make sense to just buy a call, when does it make sense to buy a call spread, and I want to use two examples here. So the example is BE. We want to trade BE if it goes above $9.58. PowerX Optimizer tells me exactly what to do. So here it says that I should buy a 9 call, so the 9 is the strike price here, with an expiration of August 21st. So let's write this down. So the idea here would be to buy a 9 call that expires on 8/21. So I want to show you right now exactly what happens if you would just buy a call and what happens when you are trading a call spread. Now, first of all, what it means trading a call spread is that you're buying a call and you're selling a call at a higher strike at the same time. But let's go step by step, right? So no worries. So I'm going here to my trading platform right now. This is one of my accounts. I have a total of 8 or 9 accounts. I lost count a little bit. There's a small account here. And I want to take a look at BE. Now again, PowerX Optimizer tells me exactly what to do. So if BE moves above $9.58, we want to buy a 9 call with an expiration of 8/21. So this is where we look at the August 21, and we are looking at the 9 call. And here is where we would buy it. Right now, currently the price is at $1.70. Now, here's the really cool thing. When buying a call, here is what happens. So if we would just buy the 9 call, you will see that our maximum risk is $170. Might be a little bit difficult to see here, so I want to write this down here. First of all, the trade would be buy a 9 call, so I just say a 9C. And the cost, we said it's $1.70. Now, options come in 100 packs, so this means that you have to bring $170 to the table. So this is how much money you need at least in your account to trade one option. By the way, if you are absolutely new to options, I have something special for you. I did a course, Options 101. I'll post a link in the description. You can download this course for free. All I'm asking is give me your name and email so that I can send you the details and I can send you the login information for this course. Anyhow, so the max risk, this is where we see here, the max risk is always exactly the amount that you are bringing to the table, the amount that you are buying this call for. So here in this case, if you're buying this call for $1.70, your maximum risk is $170. The maximum reward, and this is what you see here, the maximum profit is unlimited, because as soon as this goes above $10.70, you can make money pretty much unlimited. If the stock explodes higher, right now it is trading at around $9. If this would explode to $20, you're making money. If it explodes to $30, you can actually scroll all the way over there and you see if it explodes to $20, you would make $930. If it explodes to $30, you would make probably $2,000. Something like this. But let's go back. That's probably not going to happen. So this is where we see the profit and loss. Let's talk about where exactly the maximum reward is unlimited. Theoretically, right? I mean, like a stock is unlimited. I mean, Amazon can go to 10,000. Tesla can go to 20,000. Who knows? Not very likely, but again, we should say unlimited. So the break even, when do you start making money, is at $10.70. So if the stock moves from $9 to $10.70, in between there, you're not making any money. And this is what you see here. this is where you're still in the red. Now, you're not losing the whole amount, the whole $170 here. Let me just adjust this to 170. The markets are still open, so it's jumping around a little bit. But you see, as long as it is above the strike price of 9, but still below $10.70, this is when you're still losing money. Now, how did I arrive at the $10.70? Well, it's a strike price of 9 plus $1.70 that you paid for the call. So is there a reward cap? No, it is not. It is unlimited, right? So this is when you're trading a regular call. So now you might be wondering, why would it make sense to trade a call spread? Now, first of all, what does it mean when you're trading a call spread? It means that you're buying a 9 call and then at the same time, you are selling another call at a higher strike price. For this example that I want to show you right now is that you would sell, let's say, the 12 call. So let me show you exactly what this looks like. So instead of one option, you're trading 2 options. So you would buy the $9 and you would sell the $12. So you see, buy the 9 strike and you sell the $12 strike. Now let's take a look of what happens when you're looking at the equity curve. How does this compare to buying a regular call? Well, first of all, the one thing that you notice is that you have to bring less money to the table. Why? Because you're buying this call for $1.65 and you're selling a call for right now probably around 50 cents. We'll round it up to 65 cents, so it will be $1 here anyhow. So the cost is lower. You're only paying $100. Therefore, your max risk is also lower. So your max risk is only $100. So as you can see, you're almost cutting your risk in half by trading a call spread instead of a call. Now, here's the drawback. What about the reward? The reward is capped too. So this means that here you can only earn a maximum of $210. As long as the markets are moving, it doesn't really help. So I'm locking this $1 here. I'll lock this in place. This way it doesn't move around because otherwise my whole example always moves around here. Okay, so let's say we are buying this for $1. In this case, our maximum reward is only $200. So this is very important. With a simple call, your reward is unlimited. It can go as high as possible. Here, you are risking $100 trying to make $200. Not bad at all. Your break even is also lower because we said, what is your break even? Your break even is the strike price plus whatever you're paying for this call. So here, your break even is at $10. So you make money quicker. Now, is there a reward cap? Yes. And this is exactly when the stock moves up to this strike price here. So if it moves up to 12, you're no longer benefiting from a move to the upside. Okay, so this means that if this stock explodes from $9 to $20, you're still only making $200. Here, we talked about it earlier, when you would buy the call and it moves up from $9 to $20, you're making what, like $1,500. So here, it is very important that you have a cap. Now let's talk about another example, but let me ask you this here. Is this making sense thus far? Let me know in the comments if this is helpful, and if this is making sense, click on like, because this way I know if I'm explaining it in such a way that it's easy for you to understand, or if I'm going too fast or if I'm going too slow. If I'm going at the right pace, do me a favor, click on thumbs up. And again, if you would like to have more details on option, I have this course, Options 101. It's free. Just go to a link that we are posting right underneath the video here, and you can get your hands on the course for the whopping price of $0. Okay, so I want to show you another example, and I want to say, okay, what happens if, for example, we choose another strike price? So if we choose a strike price, we still leave the 9 call, but now we are choosing a higher strike price of 13. And this is where you will clearly see what happens. And I'm also locking this here at $1.20 for this example, because otherwise the numbers jump around. So this call spread is a little bit more expensive than this one, but not as expensive as buying the call outright. So here, if we would buy the 9 call and we sell the 13 call, it would cost us $1.20. So $120. So this also is now our maximum risk. So you might say, why would we risk more? Why would we pay more? Well, this is where the max reward now is higher. So our max reward for this trade, as you can see right here, is $280. So again, your broker platform can show you this. There's other videos that explain you exactly how to calculate it. If you want, we can go over this. But you see, your max reward is $280. The break even here is a little bit higher. It's $10.20. Again, how do you calculate the break even? You take the lower strike price, add whatever you're paying for this spread, in this case, $1.20. So therefore, it is $10.20. And here, the reward cap, you are benefiting from a move to the upside up to $13. And even if it goes to $20, you're still making only $280. So you get the idea. What is a call spread? When you have a call spread, a call debit spread, you're buying a call and you're selling a call at a higher strike price. Both have the same expiration and you're doing this at the same time. By doing so, you're reducing your cost, you're reducing your risk, you're reducing your break even, but you're also capping your maximum reward, right? So it is best to use a bull call spread. So let me write this down. When to use it, when you are just slightly bullish. So if you believe, yeah, the stock will go up, but it won't explode higher, it just will drift a little bit higher. Because as you have clearly seen, whenever it reaches the higher strike price, at this point, you cannot make any more money. So if you believe that BE can easily go to $12, but not any further, in this case, it would make sense to buy this call spread, a 9 call, and sell the 12. If you believe that it has the potential to go higher, obviously, you would choose a higher strike price. The higher the strike price for the sell, the more expensive this spread becomes again, but then also you have to risk a little bit more. Your break even goes slightly higher and your reward is higher. Is this making sense? So this is debit spreads in a nutshell, because many people are asking about this and they're asking, when should I use this? So now you know buying an outright call usually is more expensive, and you're doing this if you're expecting an explosive move to the upside. If you're expecting that the stock will only go a little bit higher, you basically set the upper range here by looking at a chart, for example, and say, yeah, you know what? I don't think that this year, BE in this case, will go higher than $14. And if this is the case, you could just enter a spread of 9 and 14. And in this case, you see that your risk would be $125, and the maximum reward, if it goes all the way up to 14, is $375. Anyhow, so by using bull call spreads, you're limiting your reward potential, but you're also reducing your break-even point, you're reducing your cost, and therefore you're reducing your risk. Well, let me know if this is helpful, and I will link to a few other videos here that might help you as well. So take a look at any of these other videos, and for sure get this Option 101 course for the whopping price of $0 so that you get a better understanding of what options are, when to use options, and when it is more beneficial to just buy a call or trade a call spread here. Hope this helps. If you like this video, click on like and subscribe to the channel. Now, go and watch one of the other videos.